development financial institutions are absolutely key for the markets in Africa. In some of the markets, they're one of the very few players, both on the financing of debt and the equity side. They work with governments to create frameworks under which bankable projects and infrastructure can actually happen. And an example of this is the World Bank Scaling Solar Project, which happened a few years ago and essentially provides a framework for governments to bid out solar projects on a consistent basis. There is financing and de-risking guarantees already embedded in that project. And of course, that allows multiples, it makes individual small projects actually scalable and investable for institutional investors. The presence of MDBs in transactions actually gives a lot of comfort to institutional investors to invest alongside them. And of course, like everything, they can't be perfect. There are areas in which development financial institutions need to improve. And those include carrying in more institutional capital, more private capital into their local markets, as well as when a market is sufficiently developed, leave that market and let the private market really finance the infrastructure projects there. From an institutional investor perspective, unless we lend alongside a development financial institution or an MDB, where you benefit from certain protections. So when you lend alongside a DFI, you benefit from preferred creditor status, withholding tax exemptions, and actually their access to powerful people within the country. So lending alongside or partnering alongside a development financial institution gives you some comfort to invest in African public infrastructure. However, if an institutional investor or private investor is going to go in these markets on their own, quite often we prefer actually to shy away from public sector infrastructure, and we prefer to be closer linked to where the growth is, so to the users, the you and me's of the world and who live there, because of concerns like transparency and stability of regulatory frameworks. I'm not going to tell you anything new, just taking things more widely. The rule of law is something that we tend to have concerns about. There is lack of public-private partnership programs. Projects are too small. The underlying transactions are usually quite lowly rated, so investors require much higher return, but that in turn makes the projects not sustainable. So there's quite a lot of things that none of them is new. They've been present for a long time. And also one of the other things that we find quite often, there aren't plentiful credit-worthy counterparties with whom to partner there. And of course, that always scares you when you're in a jurisdiction that you're not locally present. It was interesting, I think it was March or April, where we really saw a significant liquidity come out of the market. Sovereigns were not able to finance themselves. That was in public capital markets. That was the case also for sub-sovereign entities. So pumping in liquidity was extremely important, both at the sovereign level, but also at the local development banks, who essentially are the entrance point for SME lending. And SMEs, small medium enterprises, really needed liquidity at the time. So what we saw happening is private capital just completely pulled out, or the spreads moved out to a place where it wasn't possible for some of the countries to finance themselves. MIGA, for instance, part of the World Bank, came up with an interesting proposal that some of the development banks in Africa benefited from, which is essentially a 95% guarantee on debt for lenders that were lending directly for COVID-19 response. And then the sub-sovereign entities, or the sovereigns, were, in this case, the development banks, were receiving the money, and they could deploy that either for SMEs that needed liquidity to ensure that the market continued operating, or for medical equipment. But both of this, so it was interesting how blend the finance techniques, established products of the World Bank were used to crowd in investors very quickly in order to respond to a crisis, and that was occurring in this market from a capital markets perspective.